Angel investing isn't just a boys' club, it's a business move. We're not asking for seats at the table, we're buying cap table. Tonight, I'll show you how you can vet startups, spread risk like the pros, and back the future you actually want. Grab your planner. We're writing checks with strategy, not vibes. Hello, my money mavens. You are listening to the Do Different Better show. I'm your host, Elaine Rasmussen. This is the show where we talk about wealth, wisdom, and money moves, making finance simple for everyday people. I am your host, Elaine, and I am the founder and CEO of Social Impact Now and Connect Up Institute and managing director of the Integrated Capital Fund. I'm so glad you're joining me today because this is a topic that I am super passionate about. And today what I'm going to be doing is I am going to be demystifying the game, right? And this is really about angel investing and how angel investing is your personal capital fueling very early stage companies that often are right in your own backyard. Think about pre-seed or seed, high risk power outcomes, right? The translation is many singles, a few strikeouts, and if you play it right, one or two home runs that actually carry your whole portfolio. Say that 10 times. So first, let's talk about what is the role, what does an angel investor even do? Well, as an angel investor, your job is to act like an angel, but not to fix the company. It's to price risk, to back the talent that's running the company and create some options and optionality. What you actually bring is three things. Obviously, capital, right? But you're also going to be talking about what you're going to be providing really smart help. You're going to be providing introductions. Maybe it's to a customer. Maybe it's to another, you're a network of investor. Maybe it's to some key hires. It's really helping them strategically within the business, right? It's a big leverage point that gets them to the next level, but you're also providing like your expertise. I call it your time, your talent, and your treasure, but I'm going to put some guardrails on that. So the first thing you want to do is really set up your own expectations that you're thinking about. You're going to be making an investment that is parking your money for about 7 to 10 years and being okay and still sleeping well at night, right? If that is not something you think that you're in a position to do, then angel investing is not for you. It should be a portion of your portfolio, not your entire portfolio. And I probably wouldn't even recommend it being your first investment, right? I really encourage you to think about talking with an advisor and your first set of investments to be something really solid and safe, especially in the beginning of your investment journey. But as you get a little bit more sophisticated, you're like, oh, I have discretionary income. I once had a woman I talked to. She's like, I got a $10,000 bonus. My expenses are paid. I'm taken care of. I have savings. I have a 401k, but I really like to do something different with this $10,000 since it was something I wasn't expecting anyway. So that's certainly a good time to think about options like angel investing. So the next thing you want to do is really pick your lane. Not all angels operate in the same way. You really want to pick a lane that matches your time, your talent, and your tolerance. So thinking about, direct checks, this is where you're going to source the deal, build a tiny thesis, and negotiate your own terms. But also, there's a lot of control here, but there's also a lot of homework when you're doing it this way. The next way is syndicates and special purpose vehicles, SPVs. I've talked about this as well on a previous episode. This is when you're following a trusted lead who's done the diligence already. And we've talked about due diligence, right? What it is, what is included. But you are going to be paying carrying fees for access and the administrative management of all of the legal things like the accounting as well as any sort of reporting or compliance. Then there are angel groups. So we've talked about angel groups in the past. This is community plus education plus vetted deal flow. You're vetting it as a community. You're vetting it as a group. You're also co-educating each other on different things and different opportunities, but also different things to be wary of as far as the types of investments that you're making. This is really great for when you're trying to get reps in and to get more connectivity to other people doing the same thing and creating a network around your angel network investment or angel investing with other angels who are either on the same journey as you or might be a little bit further ahead. There are also some great online platforms where you can write smaller checks, and that this will give you some diversified access. But I encourage you to read the fine print on the fees and the rights that you have as an investor. There's also funds, or sometimes what are called roll funds. These are things that are funds that outsource picking to actual managers. They definitely have fees and carrying costs, and you trade control for the diversification or de-risking within your investment portfolio. Now, here's an eligibility note I want you to be careful of. Some of these offerings require accredited investor status and some don't. So you want to make sure that you've read or maybe even asked the question, is this opportunity available to only accredited investors or is this opportunity available to non-accredited investors? Read the current SEC rules and platform terms. If it's not clear, that's a red flag by itself as far as the potential organization that you're looking to potentially invest in. Okay. Now let's talk about the instruments and the terms, right? In just plain English. Deal paper is where angels get spun out. So I'm going to unspin it for you. There's about 4 ways, the biggest ways that you can leverage an investment as an angel into an organization. The first is what's called a SAFE, right? Or simple agreement for future equity. I've invested through SAFEs, and here's what they are. It's when the investment converts to equity at a later date. They usually are tied to some kind of benchmark or metric. Maybe it is, you'll see the word commercialization. Maybe you'll see the word that they actually have to hit a certain revenue benchmark, or if it's a SaaS platform or tech platform, they want to hit a certain number of users, and that's when your equity will kick in. All of that, though, is pre-agreed upon. And usually with a SAFE, it's pretty standard. So everyone who's coming in at the SAFE level is getting the same thing. You may not necessarily have a lot of negotiating power, right? But the thing you want to watch for is the valuation cap, how high the price can be when you convert, right? What the discount or the percentage off is going to be offered at that particular fundraising round, and the MFN, if better terms show up that you can match. But there's no interest and there's usually no maturity date, meaning it's not going to be set for a set amount of time. But the thing, and I've experienced this, that if they don't meet certain benchmarks or if they just can't get it together, the company may close. That has happened to me where I made an investment and over the course of 2 years, the company ended up closing. So I basically lost that money, but it was a tax write-off, right, to a certain degree. So once again, it's no different than any other investment. You want to make sure that you put in what you can afford to lose. The next mechanism is what's called a convertible note. A convertible note is a loan that has the option of converting later into equity. That can be very appealing as far as from a risk management perspective, because it is a loan. There are terms, there's a maturity date, and you get to decide at some point in time, depending on what you've agreed upon, of when at what point you're going to call that loan. And if they're not able to pay or they're not willing to pay, it can convert to equity, right? This has interest and maturity and usually includes a cap or discount like a SAFE, meaning the future value of the business for a stock price is discounted because you made the investment at an earlier date in the company. So that's basically, in the simplest terms, what it means. If maturity hits before a priced round, you may need an extension or a conversion. Okay. Next is a price equity investment. You're actually buying shares now at a price per share. Key terms that you want to look at is liquidity preference. who gets paid first and in what order. That could be 1x non-participating is common, or pro rata rates, your right to maintain ownership in future rounds. So basic protective provisions, meaning that, so think about it this way. If a company is selling a stock, they have 1,000 stocks, they're selling at $100 a piece, right? And you are making sure that you want to think about, or the dilution comes in as every single investor comes in. What was once valued at $100, depending on what they've invested, could diminish what your position is. So the value you might have will go down because more investors have come in. So this is where you want to look at the capitalization table. Who is invested? When did they invest? What obligations to pay, or what are they due at one particular point in time in the business, and see if that aligns with your own time horizon and liquidity needs for your particular investment. So what actually moves your return in that situation is entry valuation and the ownership percentage. What actual slice are you getting of the ownership pie of that company? Also, you want to think about dilution. How much of that slice do you get to keep as more investors come in? And then you want to look at follow-on rights. Can you double down on the winners? And then time to exit, or the next price setting round, if that's the time for you to exit. And that is also a strategy of like, I'm going to be an angel. I'm going to come in at this point in time. The company is set to do Y by X amount of years. That's actually when I want to get out, and I want to take that money and invest it into another company. That could also be a strategy, right? The limitation that you want to think about is you definitely want to discuss the strategy with your portfolio manager or wealth manager, but understand they may not be able to give you advice from a compliance perspective because it is not a product that they have vetted. They are very limited in advice that they can give you on anything that is outside their particular firm because it has not been vetted through their own compliance and due diligence process. So just understand if your wealth advisor might be a little cagey about talking to you about a private investment, that is typically the reason why. Right. But so the other things you want to think about is founder quality, their ethics, their coachability. That's a big deal for me. If I find a particular person and they don't appear to be coachable, I don't even want to mentor them. I don't want to work with them at all, because what they're not going to do is give me any more gray hair because they don't want to listen. Right. And entrepreneurs are hard-headed in general, myself included. But at least if they can say, like, you know what, I'm going to think about that. I'm going to take that in. I'm going to sleep on that. I'm going to talk through that with my team. That at least is telling me you're open to coachability, as opposed to like, no, I don't want to do that. That sounds stupid. Okay. I have no tolerance for that. Zero tolerance for that. Some people do. I do not. That is not my ministry. I just got to let you know right now. Okay. If a deal is priced like a Series A, but it looks like a prototype, smile and say, thanks for sharing. That may be the point where you might think about walking away. And then the last thing I'm going to talk about is risk, returns, and allocations. So angel returns are very lumpy. They're not like a regular cash out that you're going to get like a CD or some other types of investments, or even a stock dividend. But here are two rules that consider. Build enough shots on a goal. Aim for about 15 or 40 positions over a period of time, right? So just like a portfolio manager of a fund, they have 10 to 20 portfolio companies because they're banking on a couple of them are going to fail, a couple of them are going to skyrocket, and the rest of them might kind of stay in the middle, kind of like maybe your fifth grade class, right? Right? There are these star students. There were the students you're like, I am worried about your whole future. And then everybody else is kind of scattered in the middle, right? So keep a consistent default check size so one shiny pitch doesn't hijack your whole entire strategy. This is why it's really important to really be clear about your investment thesis, knowing how much you are going to make, the investment you're going to make. What is the time horizon by which you need that money back, if at all? So think about reserving 25 to 50% of your total angel allocation for follow-on capital. The company might need additional capital in 2 to 3 years, but only into true outliers, thinking about they've had some breakout traction, meaning they maybe exponentially exceeded benchmarks. They had a great round lead, and make sure that the terms are super, super clear and clean, right? So here's a tax side quest, and talk to a pro. There is, benefits on investing in qualified C Corp stock that is held over long periods of time. But paperwork matters. So don't discover any of this at your exit. It could be really painful financially and mentally and emotionally, right? So also finally think about guardrails. And this is thinking about power and not permission. So don't slide into the mentor trap. If you're doing real work, ask for an allocation or an advisory grant. I'm actually working with a founder to craft an agreement about this right now of like, I'm going to be providing you a level of expertise as an advisor. And so that qualifies as some kind of grant back to me over time if we hit certain benchmarks. That's how we have set up our agreement. If the company hits certain benchmarks within a certain amount of time, and we actually have levels of benchmarks, right, at our tenure that, after 9 months and after 24 months, and if certain things are hit in that time, then I qualify for an advisory grant. This is where you want to standardize your quick screening, right? And so remember, the one thing I really want you to remember, no is a whole sentence. You can pass respectfully without giving a whole dissertation or TED Talk. They are used to hearing no. You will not hurt their feelings if you tell them no. And you can just say, hey, it's not aligned with my investment portfolio thesis. It's not aligned. Or I've actually, I've deployed all of my allocation for this particular time period. These are all great responses, and it's responses that are reasonable and rational and acceptable by an entrepreneur. And if it isn't, that's also another red flag as far as like, is that an entrepreneur you would want to work with if they are for some reason have not, they're not willing to, they come back with a bad attitude. So here's one thing that you can do. Open your notes app and think about 3 decisions before we go to the next segment. So 1, think about your mission. I back a sector, a problem, a community because, and what, fill in the reason. My angel sleeve is what percentage of your investable assets over X amount of years. My default check size will be slot in number per deal plus whatever percentage, fill in the percentage, reserved for follow-ons. Simple as that. And once again, this is a fluid thing. So if you find like you landed on something having no information, right? You're just starting this journey. In 6 months from now, you might want to modify this statement, and that's okay. That actually should be expected. I'd be concerned if you have the same statement when you start as 1 or 2 or 3 years from today. And here's a bonus. Pick 2 pathways you'll actually use, meaning an angel group and 1 syndicate. That's going to be your on-ramp. So here's my quick call to action. If you want the Angel 101 checklist and deal memo in a minute template, subscribe to my YouTube channel, Do Different Better. With today's resources are waiting for you, and if you're a visual learner, I've posted an Angel Pathways map on Instagram at Do Better with Elaine. You can save that for later, right? Hit me up in my DMs. Let me know if this episode or this segment was helpful, but I want you to vet like a pro. So coming up in the next segment, I'm going to give you some signals so you can separate the sparkle from the real inside of less than 10 minutes, and then get to a deeper dive of due diligence. Stay with me. All right, my Money Moves Mavens, you are listening to the Do Different Better show. I'm your host, Elaine Rasmussen. Okay, now it's time to separate the signal from the sparkle. This is my 6T fast filter, a 10-minute screen that tells you whether a deal earns more of your time or it is a graceful pass, right? So this is how you get to use the 6T fast filter. Set a 10-minute timer. Give each T a scope of 0, which means heck no, or 1, meh, shrug emoji, or 2, strong. I love this. This is amazing. And it actually hits the bells and whistles. The max score of the 6T filter is 12, right? So you're going to score all these. I'm going to go through each one of them. So get ready. Get your pencils ready. If it's a 6 or less, you're going to pass on this deal. If it's a 7 to 9, maybe you dig a little bit deeper, you do a little bit more due diligence. Maybe you talk to your advisor, you talk to your partner, you talk to your angel investing group about it. A 10 through a 12, I highly encourage you to schedule a diligence call with them, right? Once again, you're not making the investment. You're getting deeper into the weeds. This is your pre-screening, your pre-call before you actually start to talk to them and ask them for more information, like they're going into their data room or whatever the case may be is. So the first thing, team, here are some questions. Do they have founder market fit? Have they shipped the product before? Have they moved fast and tell the truth? So here are some green flags. They've got gritty execution. They've got some great stories about how they've actually overcome some hurdles. They've owned their mistakes, and they have a clear hiring plan or spending plan or operational development plan, right? They're like, we know exactly what we need to do. We just need some capital. And with that capital, we're going to do X, Y, and Z. Here are some red flags. And here are some key buzzwords that instead of receipts, they're like, we just need money energy. That is not, no, I need you to have thought through what you're asking me for, right? And what you're asking, not just me, but any other investor. So remember, the score is a 0, a 1, or a 2. Next is, number 2 is total addressable market. The question is there a credible growing market with a practical, like beachhead, meaning a big blue ocean? Are they actually going to be driving into a big blue ocean of opportunity? Right? So here are some green flags. The bottom up math, meaning price times users is the wedge, and that there's a realistic serviceable slice. If somebody says, hey, when you ask them what their customer is, they're like, everybody's my customer. Red flag. If they say, hey, we have a unique avatar, these are their demographics, these are their psychographics, we have identified that the total addressable market is 1 billion, and we're looking to gain 1% of market share. 1% doesn't sound a lot, but it sounds reasonable for a startup organization, right? Here are some red flags. The $1 trillion total addressable market slides with no wedge in them of what they're going to achieve and the pathway to achieve it. So again, score 0, 1, or 2. Number 3, timing. So here's a question. Why now? Is there been a tech shift? Is there been a regulation change? Is there a cultural moment that you're tapping into? And is that cultural moment temporary, right? Or do you see it being a longer embedded thing? Green flags, new distribution channels, cost curves falling, or policy tailwinds. There's maybe a new policy is on the horizon, or a policy is actually on the decline. It's going to be taken off the books of the statutes or whatever the case may be is, right? Some red flags are the solution in search of a problem. We have a solution, but people don't know that it's a use. Now, there are exceptions, right? I talk about the iPod. When the iPod came out, nobody thought that they needed 1,000 songs in their pocket. They were very happy with their Walkman, right? And be able to swap out the music that they wanted at any point in time. It took a lot of years for the iPod to actually catch on and be a mass movement, which obviously led to the iPhone, right? But again, you're going to score 0, 1, or 2. Next is traction. So the question is, what evidence are customers giving you via revenue, retention, pilots, or LOIs, meaning potentials for contract with dates on them? Some green flags, cohort retention, meaning the people that started with them are still with them. Payback is trending down. Sales cycles are shrinking, meaning what maybe took 180 days to close now takes 90 days to close, and that they have a plan to get that down maybe to 60 or 30 days. Some red flags, vanity metrics, and they're everywhere. These I cannot stand. I cannot stand vanity metrics because once they make you feel good in the moment and you think it's a thing, but you need to ask the follow-up question of, can I get this disaggregated? And if they can't tell you, they can't give you information that's disaggregated, that's a red flag for me. But maybe they have pilots with no end dates and no strategy, and the churning is silent. Again, score this 0, 1, or 2. Then finally, the actual tech or the actual product that they make. So here's the question. What's the edge that they have? Is it the intellectual property, IP? Is it a data loop? Is it switching costs or providing speed? Or is it costs, right? Here are some green flags. They have an unfair advantage due to experience, due to their network that you can explain in one sentence. Some red flags. Oh, we're going to build the moat later. Like later when, later how. Again, score 1, 0, 1, or 2. And the last one is the terms. So here's the question. Do the terms match the stage that the company is at? You've seen it on Shark Tanks, people overvaluing their company when they have no demonstration that they are on track to actually match that, to get to that valuation. Do the terms match the stage? Can you get a pro rata, right, on how they, or a pro forma is also to see like your projections of, are you on track to get to the place that you think that this value is company that is valued at, meaning the revenue has to match the projections, right? So green flags is that there's a reasonable cap table and prices, they have clean documents, and they are aligned with the lead, right? So red flags is Series A pricing on a napkin or stack safes with no cap table clarity. Once again, 0, 1, 2. So timer is off. Okay, score is tallied. Did you get less than? Is this business less than? And the way that you're going to get all this information is typically through a deck. The company that you're looking to invest in will have a what's called a pitch deck. They will send that to you, or they will invite you to a pitch, right? And they might be pitching multiple people at a time. But based on that, you can get the answers to these questions, at least at a 10,000 foot level, right? So once again, if this less than score, bless it and release it. 7 to 9, put it in the maybe pile and ask for maybe a 20-minute diligence call for follow-up. If it's a 10 and a 12, you've really earned a deeper dive and like getting into them, right? So now we're going to get into what is deeper diligence. The goal here is to prove or disprove the story quickly and respectfully. Again, this isn't you becoming their best friend. You're not going to date them per se. We're just courting. We're hanging out online. We're flirting. We're sending heart emojis, that kind of thing. That's what we're doing at this stage. And so some of the things that you want to think about are the unit economics, right? Customer acquisition costs. What's fully loaded customer acquisition costs by marketing channel? You also want to ask about lifetime value based on the gross margin times the contribution period times expected retention. Basically, that's all fancy words of like, how long can you keep a customer, right? And what is the dollar value of keeping that customer over a lifetime, right? Then there's payback period. How many months to recover the CAC? You definitely want to think about 12 to 18 months in many SaaS or consumer industries or solutions, right? Then you want to talk about the burn rate, right? So that is what's it costing you to actually run the organization? How quickly are you burning through money and customers, right? So here's some green flags. Founders know their numbers and they have caveats like, hey, we can achieve this if these things happen. We won't achieve this if those things happen, right? Red flags are when they say, oh, we don't track that, or we're at the scale stage, right? No, I'm concerned. They may not have a sophisticated level of tracking. I'm okay with that, actually. For me, that's my investor profile. I'm okay if you're maybe not as sophisticated in all of your tracking of your metrics, but that you're tracking something and you're like, hey, and we're looking to get better at this. I can put my heart around that. I'm like, okay, that's somebody I can work with again, right? So now we want to talk about retention and quality of the actual revenue in the business. So this is where you might want to say, show me a cohort chart. Are later cohorts retaining better or any revenue concentration over 20% with one customer? That's a concern. How do renewals or expansions actually work in the organization, right? The way that it's set up. Next, you want to think about moat and defensibility. So what gets harder for competitors the more you win? Is it your data? Is it your network? Is it integrations? Is it compliance? Do you have exclusivity on some contracts, or first in, you're godfathered in because there's a new regulation that's coming in? Those are all things that have competitive advantage. And so really understanding what those are is going to be really important, and making sure that the founder knows what those are, and thinking about what can incumbents copy inside of 90 days, right? So I was talking to a business the other day, and I'm like, this is great, but there's nothing proprietary about this. And this is what concerns me, because a big company can come in and replicate this relatively quickly. So what is going to be unique and distinct that you can offer that a big company can't offer? And there are things you can do, even though you might be providing something that might be a little bit commoditized, meaning that there's very little differentiation between you and the next one. You can do it on experience. You can do it on quality. There are other things that you can do that maybe a large company that's looking to just churn out items and not necessarily think about quality. They're thinking about price. That's not your customer. They're not appealing to your customer. So there's still a market for this kind of company. Then there's the team and the culture checks. So definitely thinking about talking to a former manager or former teammate or a former customer. Sometimes you can go on LinkedIn and you can look for the company name, and they'll have it they're listed in their profile, right? So if you just put in LinkedIn, or you put in Google, former employee, and put it in quotation marks, it'll scan the internet for people who say former employee or have that on their work history. But a question you could ask is, what would it make you hire or not rehire this founder? Meaning, as working in the company, it's a different way of saying, would you go back to working at the company? Next is the data room, and making sure that they have some key elements in their data room. One, that they have a data room, right? First and foremost. But in that data room, they have their KPIs, they have their pipeline of prospective customers, they have their cohorts, their unit economics workbook, their cap table, their intellectual property assignments, any major contracts, privacy and compliance status, and the cap table sanity. Like, it's a narrative of explaining to the cap table. If multiple uncapped safes or heavy notes are stacked above you with messy notes, expect surprise dilution later that will absolutely tick you off, right? And I don't want you to have that. So here are some red flags or no-goes. Having an overpriced round for the particular stage. So let's say there's a pre-seed at $20 with a $30 million cap with no traction in sight. That's a problem. Big red flag. XXXXX, right? Here are some of the toxic tells. A founder that's really blamey and does not take any accountability for maybe the mistakes or bad decisions that they've made, either themselves or at the leadership team level. There's a high churn with lots of excuses explaining the churn, and that don't necessarily seem like logical or reasonable responses. Culture drama in their references. You hear like, oh my gosh, the founder was sleeping with the executive assistant or one of the other partnerships, and they were always arguing in the office, right? Messy boots. We don't want that, right? Maybe there's a regulatory blind spot in a regulated market, like such as health or fintech, with no advisor bench to help them navigate through that. Also, messy cap table, zombie safe notes, and no clarity on what the options are. So here could be a no-go script. I often find investors don't know how to say no. And that is the most frustrating thing, because they don't say anything. And that is terrible, a terrible thing to do to a founder. I'd rather you get to a quick no to the founder than to keep them hanging. So here's a script you can use. You can borrow it verbatim. It's not copywritten. So feel free to use this and modify it accordingly. You can say, hey, thanks for sharing this deal. At this stage, valuation and traction aren't aligned with my thesis, so I'm going to pass. I appreciate the look. Please keep me posted after X milestone, whatever that is. It's a simple, easy way for you to walk away, but also lets them know that the door is open if they hit particular benchmarks. So as I start to wrap up, I really want you to think about you acting as an angel investing is about investing with power and not permission. Don't avoid the mentor trap. Don't just become their mentor. Maybe, especially if you don't really have the expertise anyway that they're looking for. But if you're providing a real lift ask for allocation or an advisory grant upfront in writing if they're open to that. And maybe it's not something they can do right away because of other people that are involved in the company, but you can always ask. Or if I'm actually looking to just invest and be hands off, that's okay too, but you still want to qualify your investment, and the 6T filter test will help you do that. I want you to standardize your scorecard using the 6T method and weighting criteria to cut pattern bias, right? So again, say your number with AIR. I'm in for X amount of money on a pro rata and standard MFN. Then stop talking. But also, I want you to build a diverse co-investor circle. So women, Black and brown folks, Indigenous people, LGBTQIA, some domain pros to create some better deal flow and better diligence. Now, wrapping up this segment, I've just talked to you about how you can get started, and I've talked to you about how you can actually filter through relatively quickly. You can run through and identify if an opportunity is something that you want to go deeper on. Definitely run this past your investor advisor network or your angel investing club or your collaborators, or maybe your accountant, maybe your banker. This is a great opportunity to leverage your banker because you may be leveraging a home equity line of credit to make an investment. So bringing this to your banker is also a great opportunity if your commercial banker is willing, right? So coming up in the final stretches, we're really going to be talking about your thesis and really some practical tools to get started. I'll see you after the break. Hey y'all, welcome back to the Do Different Better show. I'm your host, Elaine Rasmussen, and we are going into the finish line of angel investing and how you can activate yourself in becoming an angel investor in a local business, right? So I'm going to set you up with a plan for your first 90 days. So we've got the mindset and we've got the filter. We've talked about that earlier in the show. Now let's build the machine, a portfolio that spreads risk, catches upside, and keeps you insane. So I am not a wealth advisor. I definitely advise you to talk to your wealth advisor on that, to talk to a professional. But this is going to give you a structure that you can talk about with them. But the goal of this is for education purposes, and you need to make decisions and do your own due diligence that works for you. So first of all, let's talk about portfolio construction, how many bets, the size, and when you should do that. I definitely think that you should target a number of positions that you want to make over a certain amount of time. Angel returns are power law. You need enough shots on goal to meet the lucky plus skilled intersection. The sweet spot, some people say 20 to 40. I say just get started, right? And you can get to 20 or 40 over a period of time. So again, if you're saying to yourself, I have $1,000 that I am going to leverage every year to make an angel investment. Well, just imagine that over your lifetime. You probably will get to 20 to 40 investments that you've made over time, right? So, but to really think about how much do you have and what's the time horizon of that. Next, you want to think about what's the check size. So again, deciding upfront what that's going to be, even if it's a small amount of money. And I'd rather you probably start smaller and grow than start large and regret it, right? So again, start with 1,000, 5,000, 10,000. I shared the story with you of a colleague of mine who said, I'm going to take my bonus every year, and that's what I'm going to choose to invest because I already have some safe investments that I'm not worried about. So if something happens to this money, it was bonus money anyway, so I'm not concerned if I happen to lose it, because at the end of the day, I help support a local business that was in my community. So deciding what your angel allocation, the dollars that you can park for 7 to 10 years, because this money is going to be locked up. You cannot go to the founder and say, like, I want my money back. That's not how this works. Definitely, you want to pick a target position. So what is the default? The default check is angel allocation divided by target position. So example, if your sleeve is $125,000 of your portfolio, you want to divide that by 25 investments. That's $5,000 per check, right? again, you might be taking a chunk of your portfolio to do this. This is a mathematical equation if you're deciding that you're going to take actually a portion of your portfolio that already exists. But if you're new to this and you're just like, I just got some extra cash and I want to invest it, you're going to take a little bit of a different perspective, which I talked about earlier, of like you're going to play a much longer game, right? Next, you want to think about reserve and follow-ons, and that means follow-ons without having a fear of missing out or FOMO. So you want to hold back 25 to 50% of your total sleeve. So using our example of $125,000, you might want to hold on to $75,000 that you don't actually deploy because it might be needed as follow-on capital for one of your investees. But only in the true outliers that show clear traction, strong lead, and clean terms. So for example, again, using $125,000, you use $75,000 for initial checks and $50,000 as a reserve. Now, next, we want to talk about a pacing plan. We don't want to clump and do everything all at once. Think about decide your cadence. Is it monthly? Is it quarterly? I definitely encourage you to do biannually because one, the due diligence process in and of itself takes 2 or 3 months to get through. So it's really hard to think about. One getting like 5 investments done in a year. That's probably not realistic, especially if you're not a full-time investor. But here's a guardrail. If you place less than 20% of your sleeve in one quarter, you're chasing you're kind of chasing deals. So I would, once again, if you're new to this, start low and slow. So definitely want to mix your access. You want a little bit, maybe blend your direct investment that has a higher level of control, adding in some syndicates or special purpose vehicles, and then maybe having a sleeve that is really a fund that actually makes direct investments into local founders. So rule of calm, one shiny deal should never be more than 10% of your angel sleeve. If it is, you're not really investing. I would argue you're actually making bets. So the other thing that you want to think about is operations and record keeping. So you definitely want to keep a deal log, right? A deal log of all the deals, not only that you're thinking about, but also the deals that you are prospecting. And so here are some columns that you can use in your spreadsheet: the date, the company, the stage they're in, the instrument that's being considered, the thesis. Is it in one of your thesis? What are some of the risk factors? Maybe 2. And then what is the follow-on status, as well as any updates, like a notes column for any updates or news or information. And then you want to be included, ask your founders to send you the quarterly investment updates, and you're going to be adding that information into your spreadsheet. So think about what's going to be important to you as far as keeping this as maybe a potential for follow-on capital. And then you're going to really thank yourself by just keeping all of this admin. So store any executed documents, wire confirmations, cap table snapshots, or anything like that in a folder. I would keep your own data room, but I would also keep paper copies just in case as a backup. If you invest in special purpose funds, expect what are K1 forms. That is a tax form that will be sent to you. Capital calls and annual statements. You put that in your tax folder. I have a folder for every year that I start at the beginning of the year. It's called that tax year. It's like, 2026 tax year. Anything related to my taxes is going to be put in that folder. K1s, donations, anything like that, those are all going to be set up for that particular timeline. So now that we've talked about that, let's really talk about some of your 30, 60, 90, your 30, 60, 90 day launch plan. So this is going to take you from zero to operating like an angel. First and foremost, I definitely encourage you to join an angel group, right? That is really going to help your learning curve and lessen your risk, because you're going to be with other people who are either on the same journey or maybe are a little ahead of you, right? You're going to start practicing the 6T filter test. There are online pitch opportunities or pitch competitions or pitching sessions. There's many cities have what's called Million Cups. Every Wednesday, they have people, founders who come and pitch, not necessarily for the goal of investment, but for the potential for the practice to pitch. So attending those, some of them have virtual sessions. You can start to practice the 6T filter test, right? This is a great opportunity to learn and practice before you actually get started. So now for 60 days, I want you to do your first check and pass with a written memo or calendar with a follow-up milestone. I want you to do 2 reference calls using the 3-question script that I provided you and create an update request template to organize and secure your documents by the company that you're potentially thinking about. Next is your 90 days. Now we're going to start to aim for looking at 3 opportunities more carefully and deeply. This is where you're going to actually set up a due diligence call to ask more questions. Now, be mindful. If you are not interested, please do not waste these founders' times. This is not an exercise of vanity, right? If you are really seriously thinking about investing in them, great. Give them a call, give them an email, say you'd like to set up coffee or you'd like to have a 20-minute Zoom call with them. Great. If you are not, and you're still on this journey, you're not ready to pull the lever, please do not call these founders. They are time strapped and they have like several people wasting their time. So please do not be one of those people that waste their time. Only start to reach out. Otherwise, you can just watch their Instagram, watch their LinkedIn, ask to join their newsletter list, and you'll get those updates and you can still start to practice thinking about the due diligence process by the information that they're sending you as opposed to spending time with them. So, I wouldn't be doing you a solid unless I talked to you about guardrails. So get to a quick no, right? Pass fast and pass kind. Quick no is actually kindness. You can always circle back later and tell them that you're invested at a later point in time or that you're interested in them once they hit a certain benchmark. Again, here's the language you can use. Hey, this isn't a fit for my thesis at this stage, but I am cheering you on and wish you every success. That's it. And don't do any revenge checks. Don't win back a prior loss by oversizing the next deal. And then take the sleep test, not a hot take. If you can't sleep with it at 2 a.m., it's a no. Write a memo if you can't capture the thesis, the edge, the milestones, and the risk in 4 lines, you don't understand the deal. So I want you to consider passing on it, right? So I know that was a lot, and but I know that you got this. And so if this episode has helped, I want you to subscribe to our YouTube channel at Do Different Better, and grab the Angel 101 checklist, the 6T scorecard, and the deal log template that I've created. When you go and subscribe, you can also hit me up on DM, comment Angel, or DM me, and I will make sure that you get access to these. And big love to our radio partner, AM 950, for amplifying money conversations that actually move communities. It's not just about making money. It's about making money move. And don't forget my event on December 14th. You can go to dodifferentbetter.com to sign up and register for our Do Different Better live event that's going to be helping you think through angel investing. So remember, it's not just about money. It's about making money move. So let's do different and let's do it better. I will see you next time.